Great, thanks. I'm Deborah Lucas. I'm the director of the Golub Center for Finance and Policy and the person who's going to talk to you about bailouts. So I'm going to jump right in. Clearly, the financial crisis reignited a lot of interest in bailouts. I would say that if the majority academic opinion is that they were unfortunate but largely necessary during the financial crisis. Although I'd say that's the majority academic opinion, I think there's far from a consensus. I know there's some people who think that more should have been done. Either other critical institutions should have been bailed out sooner, or even homeowners should have been bailed out more. And then on the other side, there's people who believe that, in fact, we did too much, that we should have allowed large creditors to take larger losses before we provided assistance to those institutions. And then on the popular side, opinions are all over the place, but there's one popular narrative that taxpayers were forced to bail out Wall Street at a very large and unfair cost. And then on the other side, you hear policymakers and others sometimes say that actually the bailouts were essentially free because everything was paid back. So in this paper, I actually try to look at the evidence on what some of you might think is a kind of a narrow take on bailouts, which is simply how much did they cost? So I want to talk a little bit about the theory behind cost measurement for bailouts and compare that to the estimates that you see in practice. You may think that's narrow. I'm going to try to convince you it's actually very important to be careful about measuring the costs of bailouts. But the very first order of business is going to be to actually figure out what was a bailout and what wasn't a bailout. And then look at the direct costs and some of the direct beneficiaries. I'll end by talking about a few of the implications for policy analysis. So I just want to first say a few words about how essential it is to be careful about the measurement of costs. Basically, you can't do cost-benefit analysis without it. You can't begin to answer questions like, did the benefits of the bailouts justify the costs? Or could the results have been achieved at lower costs? You need to know about cost looking forward for ongoing rulemaking. We really need to ask, do the costs of the regulations that reduce the likelihood of bailouts exceed the cost of bailouts? We can't answer questions like that without knowing the cost of bailouts. But I think more fundamentally, the reason that we need more clarity on cost has to do with broader issues of disagreement and discord. The range of opinions that I alluded to earlier, the sense that the bailouts were unfair, that they provided huge benefits to certain people who are maybe undeserving of them. Some of that wide divergence, at any rate, has to do with the underlying numbers. How big were the transfers? Who did they go to? So I hopefully this kind of analysis will help reconcile at least some of those conflicts. Okay, so let me just start out with a basic definition. As economists, I think we all think we know what a bailout is when we see one. And it appears in many academic papers in the title. But in fact, it's not a technical term, it's a colloquial term. I started with Wikipedia, which provides a pretty good definition, which is it's the provision of financial help to a corporation or a country which otherwise would be on the brink of failure or bankruptcy. But even with that as a starting point, there's still questions. Imagine that your house is burning down. Luckily, your children are safe outside. And also imagine that you had bought an insurance policy on your house, and the insurance company gives you $500,000 to rebuild it. Is that a bailout? I think you would all say, no, it's not a bailout. You paid for that insurance, and you're getting the value of what you paid for. On the other hand, what if your house burnt down and you're insured and you are uninsured, but your rich Uncle Sam came and gave you the money to rebuild your house? Would that be a bailout? Yes, certainly we think it is. So that kind of thought motivates the working definition that I'm going to use to think about bailouts. It's going to be a bailout if a policy action involves a transfer of resources that arises from a subsidy or an implicit guarantee or from new legislation that's passed in response to financial distress. But I'm not going to call it a bailout if there was a fair value insurance premium paid before the fact, or if there's a mechanism for ex post collection of the money. And that might seem a little bit abstract, but all of this is going to matter in what I show you in a second. Okay, so let me tell you that thinking about the direct costs of bailouts is more difficult than you might think. And maybe surprisingly, in order to think about it clearly in my own mind, I found the most useful thing to do was to go back to ideas that are implicit in what's called Arrow-Debreu state pricing. And the insight from Arrow-Debreu, this goes way back to the 50s, is that if you think about the value of resources at different points in time and in different states of the world, they're actually very different. $1 in 2006, before the crisis, when the economy was in good shape, is worth less than $1 given away in 2008 and 2009 in the midst of the financial crisis when there's enormous distress and the economy is distressed. Also, looking after the crisis, when we're back in pretty good times, money then is also less valuable. So when we're trying to ask about the cost of a crisis, there's actually there's a number of issues, but one has to do with at what point in time are we measuring that cost at, and another is what range of events do we think about in terms of evaluating that cost. So we'll operationalize that in just a second. This sounds very abstract, but I also want to say that the natural way to operationalize this idea that different states of the world have different costs is in fact in a fair value approach that recognizes that market prices reflect costs and risks to the economy, and they're an aggregation of what markets think about value. So in fact, what I'm going to do is I'm going to go through 3 possible metrics for measuring a bailout cost. The first I'd call fair value at the moment in time, or at around the time of the bailout. So what's the present value, the fair value of the assistance that was granted? That is going to be my preferred measure, by the way. So that's what I'm really going to focus on. A kind of a related idea, and one that I really don't want to have to talk about, but I do for certain reasons, is the idea of a fair value cost ex ante, before there's a specific bailout event. And I need that kind of idea for assistance that's bailout-like, but that's ongoing. So there isn't a particular date you can look at as the point of the bailout. And then third, I'm going to look at ex post cash accounting, which simply says, how much money did the government give you versus how much money did I get back? So in some sense, what people think of as common sense accounting. Okay. It turns out that these 3 approaches give starkly different answers, and I'm going to tell you about the 3 of them and why I favor the first 2 over the third in the context of Fannie Mae and Freddie Mac. Okay, so let me jump right in and say that Fannie and Freddie were the largest bailout of the financial crisis by my preferred measure. It cost in present value terms as of around 2008, 2009. My estimate is $311 billion. This is the cost at the time of the bailout on what was what you'd call a fair value basis. It takes into account that 2009 was a year where there was significant distress, and although things could have gotten better and likely would get better, they also could have gotten worse. So it takes into account all three of those yellow paths going forward as possible outcomes. Had things gotten worse, of course, the costs would have been even greater. Had they gotten better, Fannie and Freddie gets paid back. So what I did for this article is, as much as possible, I used estimates in the existing literature. And unfortunately, academics don't spend a lot of time looking at the cost of government actions. So a lot of what I'm going to show you relies on work that was done by a group I used to work with at the Congressional Budget Office. They estimated that the existing $500 trillion of mortgages that Fannie and Freddie had represented a liability to the government of about $291 billion. Then on top of that, Fannie and Freddie continued to make large originations in 2009 and 2010. And I also added that in to get to the $311 billion. What's interesting is that the Congressional Oversight Panel also looked at, sorry, let me leave it at that. Okay. Okay. In the case of Fannie and Freddie, then, the direct benefits of this bailout went primarily to their existing bondholders. They had started to experience financial distress. The Congress came in and passed HERA, the Housing Economic and Recovery Act, and that essentially gave Treasury the power to keep Fannie and Freddie solvent for the indefinite future. Okay, my preferred measure, $311 billion. One alternative is to look at the costs ex ante. You might ask the question, how much was the implicit guarantee of Fannie and Freddie worth, the bailout waiting to happen, say back in 2006? That kind of an estimate takes into account all the possibilities, including the fact that there might not be a bailout, because in all likelihood the economy would be in the kind of shape where a bailout wouldn't be needed. That kind of an estimate is an order of magnitude smaller. What I want to focus on, to contrast with the preferred estimate of a cost of $311 billion, is the apparent profit that you come up with if you simply add together the cash flows that the government gave to Fannie and Freddie and compare that to what has been remitted to the Treasury. On that basis, the government has made $58 billion on Fannie and Freddie. But I want to argue that to call that a profit might be correct in accounting terms, but it's a terrible mistake in economic terms. What you're doing is you're adding together apples and oranges. The reason I started with that Arrow-DeBrue idea is because the government gave Fannie and Freddie guarantees in 2009 that, had the economy gotten worse, wouldn't have generated $58 billion in profit. It would have been huge losses. And so this reflects the very good outcome that we're lucky to have, but it's not an accurate accounting of what the cost would be. Okay, despite my objections, the press tends to report ex post cash outcomes. ProPublica, a highly respected source, has a bailout tracker, and they tracked Fannie and Freddie and TARP. They report government profits of about $86 billion up to the present day. The kind of ex post cash accounting is picked up by politicians and policymakers. For instance, President Obama was very fond of saying that we got back every dime that was given to rescue the banks and every dime that was given to rescue the automakers. And that's a kind of a common refrain. Others also make mistakes, and they make mistakes on the upside instead of on the downside. So for instance, there was a guest article in Forbes that claimed that the cost of the bailout was $16.8 trillion. So this is just evidence of the kind of differences of opinion that are feeding a lot of paranoia on both sides. So we've gone through Fannie and Freddie. In this paper, I inventory what I consider all the major bailout actions associated with the financial crisis. Because I have very limited time, I'll put the bottom line up front, which is a total of about $500 billion in bailout costs. To put that into some kind of perspective, that's about 3.5% of GDP in 2009, where these estimates are meant to be centered. I have, I think, very, very little time, but there's a few things I'm going to want to highlight. Maybe I'll summarize them here and then start to go through them. It's really we think of bailouts as moral hazard. I have moral hazard because I'm supposed to be the timekeeper of my own session. So, so you'll see how successful moral hazard is. What I want to talk about after Fannie and Freddie is the Federal Housing Administration, FHA, where I have a bailout cost of $60 billion, which is a startlingly large number for what I'm calling a bailout, which the world has not recognized as a bailout. And I think that's the program I spent the most time thinking about, and I'm most concerned about that, so I'll tell you a little bit more about that. TARP is what you're all familiar with. It's a pretty big number, 90 billion. The two programs that I would put together, and I'll talk more about TARP, but the Federal Reserve and the FDIC are both very interesting because they both had a huge expansion in financial exposure, but in both cases, I would argue the taxpayers were much more protected from losses than maybe the popular perception of what the situation was. And then finally, there's some smaller programs that people also haven't heard of, which I won't talk about, but the Small Business Lending Fund was like a mini TARP for community banks. There was also a bailout, to some extent, of federal student loans in an administrative action that increased income-driven repayment options. So that's kind of the landscape. So let me talk a little bit more about FHA. The Federal Housing Administration guarantees mortgage for low-income and first-time home buyers. In general, taxpayers bear risk exposure for FHA guarantees because they're underpriced. And the risk exposure of taxpayers to FHA, I would argue, is very analogous to what arose from Fannie Mae and Freddie Mac. Yet it's not a typical bailout because some of the guarantees were in place beforehand, and importantly, private investors were not the beneficiaries. It was the mortgage borrowers themselves that benefited. In any case, the uncompensated risk ballooned during the crisis. Apart from the $332 billion that had been guaranteed at the start of the crisis, FHA guaranteed $868 billion additional mortgages in 2008 through 2010 at highly subsidized rates. And then the emergency legislation, HERA, that bailed out Fannie and Freddie, also nearly doubled the size of the maximum amount FHA could insure, and it also put into place a special program to help subprime borrowers refinance into FHA. So that last bit was certainly a bailout. So all of that adds up to about a cost of $60 billion. There's a little bit on the details of the calculations, but I think the interesting question here is how did such a large sum go virtually unnoticed by the press and policymakers at the time? I chalk it up to several things. The accounting for the FHA is incredibly opaque. In the world of opaque accounting, FHA is like a star player. But also in general, for federal credit programs, the way they're budgeted for is on an accrual basis where you project what you think the losses will be and the fees, and you discount it all back to the present to get a net present value. But the thing is, there's unlimited budget authority for making mistakes in those calculations, so that if the FHA takes $60 billion of losses, Congress does not have to go back and authorize that $60 billion. There's already provisions, so they can kind of not look at it. So I think it's very interesting, I mean, very, very interesting that you can have this kind of assistance with this little notice. Okay, let's go quickly to TARP. As you know, it was the major legislation that provided $700 billion of authority to buy troubled assets. Initially, most of it went to assist AIG and the large banks. both CBO and the Congressional Oversight Panel did fair value estimates, which came out on the order of $64 billion for the assistance to AIG and the large banks. I have a number here of $90 billion because there was remaining authority, some of which was ultimately used, and that added to the cost. I knew some of you would be interested in what these ex-ante fair value estimates look like coming from TARP. And actually, they correspond pretty well to what you would suspect. So the assistance to AIG was significant at $25 billion as a net present value, fair value subsidy. Also, the Citigroup assistance was quite valuable. So that's the TARP amounts. I'm feeling like I'm going to, Okay, I just want to mention, so why was the Federal Reserve so cheap? I know there's people in the Federal Reserve System who would argue they didn't cost anything. I think that's not true. Certainly on an ex post cash basis, I think the Fed probably didn't cost anything, but ex ante, they were well protected from most of the exposures they took on. It was a combination of things. The TARP was partially used to back some of what the Fed did. There was a lot of collateral involved in a lot of the facilities. The maturities were short. And then there were other transactions that involved risk, but they were transacted at close to fair value, so I wouldn't say that there was a bailout involved. The FDIC is also interesting. The exposure went up very much. Deposit insurance went from $100,000 to $250,000. At first that was temporary, then it was made permanent. But also there was this temporary liquidity guarantee program that gave unlimited coverage of transactions accounts and helped banks roll over debt. And then the Treasury expanded their credit line to cover all of that from $100 billion to $500 billion. So that seems like a lot, but the offsetting fact is that the FDIC is obligated to recover the money from the banking system, not from taxpayers. And so that line of credit from the Treasury is just there to provide funding until they can collect from the banks ex post. An interesting fact that the FDIC would be happy to tell you if you asked is that they never borrowed a penny on the Treasury lines, even through the worst of the financial crisis. And so it's fair to say that there was a very small probability of loss. Okay. Okay, so we're going to go to, I'm going to skip to the very end and say it's important to understand then that the largest direct beneficiaries of these bailouts were the unsecured creditors of large financial institutions, particularly Fannie and Freddie, but also Citigroup and AIG. Equity holders benefited less than popular perception. By the time these bailouts hit, they were close to being wiped out for the most part. How should we think about this $500 billion? Well, it wasn't trillions of dollars, and it certainly wasn't free. I think it's an interesting number because I think it's big enough to raise questions about whether taxpayers could have been better protected, but it's small enough to take seriously the trade-offs between the costs and benefits of new regulations to reduce the chance of future bailouts. So that's all I have to say about it. Thank you very much.